Welcome back, everybody. We are talking investment real estate. I am Chris Weidenbach with Chicago Title's National Commercial Services team, and today we are discussing the hot topic of opportunity zones. I am joined by the expert, Mr. Austin Bowlin of Real Estate Transition Solutions. How are you today, Austin?
Doing well, Chris. Thanks for having me.
I know that previously you have done this presentation with Kyle Williams at IPX as kind of a combination of 1031 exchange and opportunity zones. Today, we're shortening it up a little bit and just doing the opportunity zones presentation. Also, if you didn't check out our discussion last month, Austin and I did a great presentation on Delaware statutory trusts, and you can find it on my YouTube page or LinkedIn. So Austin, give us a brief scenario of kind of what you're going to go over today, and then I'll actually pass it over to you and you can jump right into it whenever you're ready.
Perfect. Okay. Well, appreciate you having me, Chris. Always a pleasure to join you and provide some educational content to investment property owners out there. Today, what we're going to talk through is opportunity zones, a high-level overview of what opportunity zones are, how they came about, what the structure and tax incentives associated with investing in opportunity zones are. And then one slide right at the end, which I think is particularly interesting, especially for investment property owners, is going to be a comparison of investing in opportunity zones versus doing a 1031 exchange. Really, two of the primary tax deferral or tax mitigation strategies that are available to investment property owners. So looking at, when you have both available to you as options, which one would be a better fit? And the answer, that's always going to depend on what your particular objectives are. But knowing the differences between the two, I think is definitely of value. So that's the overview. To start things off, you hear a lot of conversation about opportunity zones. It's a little bit of a buzz phrase, if you will, in the investment real estate space, and has been really for the last 2 years or so. Many folks aren't overly familiar with what the structure is, and it's not too complicated. What it is at its core is it's a program that was put forward in the 2017 Tax Cuts and Jobs Act, which was effective as of January 1st, 2018, that really tried to steer and incentivize investment in particular areas, what are called the opportunity zones, in areas that historically are either impoverished in some capacity, or they weren't seeing the level of development in which they wanted, and they were trying to incentivize that capital to flow to those particular areas, and very importantly, create jobs in that process. So what ended up happening is the program was put together by two senators that co-sponsored it. That was Cory Booker out of New Jersey and Tim Scott out of South Carolina. They wrote it, the section of the Tax Cuts and Jobs Act that spoke to opportunity zones fairly quickly. And there were a number of, shall we say, pieces of the execution or implementation that really hadn't been fully developed by the time they put it out there. And so what ended up happening then is they didn't see nearly the level of investment in which they would have expected in the first year, because there was so much ambiguity and uncertainty. They put it out to the states, the individual governor's offices, to identify where they wanted the zones to be, to submit those to the U.S. Treasury to review them. Typically, they're working off of, I believe it's off of zip codes in terms of how they actually define the boundaries themselves. Then they put guidelines out there as to a certain area median income that the residents of that particular zone needed to have in order to qualify, or a percentage of the population that was over a poverty rate, or there were certain carve-outs such as being able to recommend and put forward any sort of tribal land. And then also the states had a certain allowance of zip codes that they could then put forward that didn't meet any of the criteria of quote unquote needing incentives to invest in it, but that they wanted to steer capital to regardless. And often that was going to be some sort of transit-oriented development. On a local example, you'd see that in Washington, the entire Bremerton area was put forward as an opportunity zone. And that was largely because they had built the fast track ferry system. They wanted people to now have amenities and services over there to incentivize folks to live over there, and then ultimately utilize that ferry system and commute into Seattle. Here, over on the right side of this particular slide, you'll see where the zones lie in the Seattle area. And these are not areas that were exactly static from an investment standpoint. You have Soto, Georgetown, you can see Yesor Terrace in the International District in there. Certainly the kind of MLK and Jackson area, Africatown, et cetera, in the South Central District. And then also the New Holly, Othello, South Beacon Hill, Rainier Valley area. Both of those particular regions were included in, and both areas that we've seen a significant amount of investment in over the previous years.
That's great, Austin. And I will point out that Austin and myself, while we are based out of the Seattle area, a lot of the examples you'll hear are familiar with that geography. We both are national firms. And so for those of us, or those of you who are joining us from the national side, we can put this same information together for your specific areas or for the entire nation as a whole. So great resources that we can both provide for you. Just wanted to point that out, Austin.
That's a great point. And this phenomena that we are displaying here within Seattle carries true to pretty much every city where there are neighborhoods, whether we're talking about Dogpatch in San Francisco or whether we're talking about the waterfront in Cleveland, where there are zones that some folks looked at and scratched their heads and said, I thought this was supposed to be about areas that weren't receiving investment. These areas have already been receiving investment. Why are they included as zones? Not all zones are created equal. There's many zones in which folks, even with the tax incentives, still would choose not to invest in. But what ended up happening then is the state submitted their nominees, if you will, for where the zones would fall. Treasury reviewed them, and then over the course of 2018, they approved the states. And by I believe about September 2018, all the states had been approved, all 50 states plus all of Puerto Rico is an opportunity zone. And then at that point, it was really centered around how do we build the framework such that folks have certainty for the tax treatment and what sort of investment requirements are we going to put in place for those choosing to invest in opportunity zones. One thing that's worth noting is that you can invest in an opportunity zone in two forms, one of which is through real estate, which is what we're talking about and focusing on today, given that both Chris and I work in investment real estate, as do our clients. But you can also invest in opportunity zones through a business investment, through an actual operating entity. Not my area of expertise. I only work with investment property owners, but that is something worth keeping in the back of the mind. So what are the tax incentives associated with opportunity zones? This was really cleared up in the middle of 2018, and we'll use an example as if funds had been invested in 2019, and there will be a key distinction for funds occurring from today forward, which I'll be sure to note. What happens is, first off, you only need to invest the gain derived from the sale of an asset. So with the 1031 exchange, there's a requirement that you buy equal or greater value, you use all of your net equity, you invest the total amount in your replacement property. That doesn't stand true for opportunity zones. It can be a gain generated from the sale of any type of asset, and you only are required to invest the gain, not whatever the basis in that property would be, which for some folks is going to be substantial, especially if it was a relatively newly acquired property that ended up generating that gain. Once you invest the gain into the opportunity zone, then the tax associated with that gain after a 5-year hold period receives a 10% step up. So effectively, your tax liability is reduced by 10% after having held the investment in the opportunity zone for 5 years. Now, after the 5-year step up, once you hold the property for another 2 years, you would qualify for an additional 5% step up. So now we're talking about a 15% reduction in the tax liability. But what's interesting is that the program is not perpetual. It's set to expire. And this 2026 date that you see, tax liability being due December 31st, 2026, that's a hard date. So at this point, given that there are no longer 7 years between today and 2026 in which the tax is due, folks who are new investors into opportunity zones will no longer qualify for this additional 5% step up. They will only qualify for the 10% step up realized with a 5-year hold period, and they will only qualify for that if the investment is made in 2021. Any investments made after December 31st, 2021 will now not receive either of these benefits, the 10% or the 5% step up. The tax liability is then calculated and due December 31st, 2026. It's worth noting that that's going to be calculated based off of 2026 capital gains rates, not off of the original deferred rate. So you are bearing a certain level of regulatory and tax risk if moving forward with an opportunity zone investment. The 2 step ups are all well and good, and I think everyone would appreciate a 15% reduction in their tax liability. But the real incentive for opportunity zones is this last component. Upon having held the investment for a minimum of 10 years, and then understanding that you did pay all or some of your December 31st, 2026 tax liability, after a 10-year hold period, there is now no tax applied to any gain beyond the fair market value as of 2026 until 2047, provided you sell whatever asset it is that you've invested in the opportunity zone between 2026 and 2047 and have held it for a minimum of 10 years. So you could see a scenario whereby, if we were talking about a December 2020 investment, say you sold a property for $2 million, $1 million of which was gain, you are able to take the $1 million of basis and use it for whatever you please, no tax consequences associated with it, and then you invest the $1 million of gain into the opportunity zone. You hold it for approximately 6 years. You receive the 10% step up, so now your taxes are calculated off of $900,000 of gain. And then after you pay the tax liability December 31st, 2026. And then after a 10-year hold period, you choose to sell that property, which now may be worth, let's say, $2 million again, or $2.5 million. And there's no taxes due on the $900,000 to the 2 million sales price or 2.5 million sales price when eventually down the road, after that 10-year hold period, you sell it. There's quite a bit of opportunity for appreciation in that window of minimum of 10-year hold, maximum of hold until 2047 as well, because the opportunity zone requires that any real estate investment be done in a way that's going to significantly improve or enhance the property, which really means that we're seeing most dollars going into opportunity zones going in through ground up development. So a couple of the rules for compliance. One, your investment has to technically be done through a qualified opportunity fund. That's any sort of regarded entity. It could be an LLC, it could be a partnership, but a individual cannot go and buy a property and have their own name directly on title and have that constitute a opportunity zone investment. It does need to be in a certain regarded entity structure, which then acquires the underlying real estate. Then the IRS has also said, Treasury has also said that you have to substantially improve or enhance the property. So what does that mean? I mean, that seems like a fairly loose term there. the way they quantified that was they said, if you are to buy real estate, with any acquisition of real estate, there's going to be an allocation between land value and structure value. So you purchase a property for 5 million, you might see, let's say 2 million on the land, 3 million on the structure. And they require you to take whatever value is attributed to the structure and double that in terms of your investment in improving the structure. So you buy that $5 million piece of property, $2 million of land, $3 million of structure value, you need to invest another $3 million into improvements. Unless you're dealing with a severely dilapidated building, that's a very high bar to meet, very difficult threshold. So again, we don't see a lot of value add work. What we see is really ground up construction, where that $5 million property is actually 4 million of land, maybe $1 million of structure value or less, and they're scraping the structure and then building ground up on top of it. The change of use is what you would expect, any sort of change of use as it relates to the occupancy, certificate of occupancy and primary use from the municipality. So if you were to convert, say for instance, a office to self-storage or retail to self-storage, which is something we're seeing occur right now with some big box retail, or if you were to convert industrial to multifamily, that would constitute the change of use, and there's not a dollar threshold associated with that. Given that you have the requirement to invest in the property at a certain level, there's also a testing process in place to make sure that the funds that you've raised as part of the Opportunity Zone Fund are deployed in the property and not just held as cash. So there is a biannual, twice a year test to verify that 90% of the dollars that were collected in the Opportunity Zone Fund have been put into play to improve that particular property. Understanding though that when we're talking about especially ground up construction, there is a development timeline. So you do have a 31-month window from the date in which you raise the funds to deploy the funds in terms of actually improving the property, with a written plan in place to show the IRS, hey, we have a process by which we plan to spend this money, and some leniency too in terms of should there be a permitting issue or COVID, for instance, or a municipality that's dragging its feet in some capacity, they will grant extensions for that 31-month development window, but they want to make sure that you are on a timely basis updating the plan and reflecting a way in which those dollars will be fully spent. So given the overview of the structure and the tax incentives associated with the Opportunity Zone investments, that brings us to comparing 1031 exchanges and opportunity zones. And again, going back to what I mentioned earlier, for sales of investment real estate, whereby you have both these options available to you, I mean, it's a very worthy question, and the answer is largely going to depend on what your objectives are. When we look at the deferral of the old gain with 1031 exchanges, which you'll see on the left, the deferral is technically temporary, albeit you have the ability to perpetually defer if you continue to own that real estate or do subsequent 1031 exchanges. Additionally, when an owner passes away, there is a step up in basis, whether it's 100% step up or a 50% step up, depends on whether you live in a community property state or not. With the opportunity zones, you're going to have temporary tax deferral on your original gain. And originally, that was 85% tax deferral if you had held it for the 7 years. But now we're looking at 90% tax deferral, and that will change at the end of 2021 as well, whereby there will be only tax deferral until 2026, but no step up occurring in that period of time. The new gain generated from any appreciation of the investment amount with a 1031 exchange can continue again to be deferred, provided you do subsequent exchanges or do not sell the property. With the Opportunity Zone investment, you're looking at a minimum 10-year hold and no tax calculated on the appreciation provided that property is sold in 2047. The timing is looser for the opportunity zone investments. That's one of the drawbacks that many folks see with 1031 exchanges, just how rigid the timing is. Upon the sale of your investment real estate, you have 45 days to identify your replacement property, followed by a subsequent 135 days to actually close on it, giving a total timeline of 180 days for the exchange to be completed. Again, very rigid, very few extensions granted. And with the opportunity zone, there is no identification period, but you do still have to adhere to the 180-day investment timeline. That 180-day clock will begin either upon the sale of the asset that ended up generating the actual gain, or if it was owned in a, say for instance, partnership or some sort of regarded entity, when that partnership filed its tax return and then pushed the tax liability down to the individual taxpayer. As we were talking about earlier, with the 1031 exchange, you do have the requirement to use all of the net sales proceeds and acquire equal or greater value property in your replacement property in order to have full tax deferral. Of course, you can do partial exchanges, but that will trigger a tax liability. And with the opportunity zone investments, the requirement is only to invest the actual amount of gain realized on the sale. So for folks who have a healthy amount of basis left in their property, the benefit of being able to only invest or being only required to invest the gain becomes more significant. For folks who have owned property for decades and it's appreciated significantly and they have depreciated the original basis that they had, this ability to invest only the gain in the opportunity zone becomes less relevant given the fact that the vast majority of the sales proceeds is attributed to gain. Investment source, there is a tracing requirement with 1031 exchanges. It's exactly why Chris and Chicago, Ticor, Fidelity have a in-house qualified intermediary in IPX, because they require an entity to hold on to exchange proceeds while the actual 1031 exchange is in play. With an opportunity zone, there is no tracing of the funds, no requirement that a independent third party hold those funds on behalf of the investor until the replacement property is identified and acquired. So funds can be, you can use them as you please and take possession of them and substitute different funds in. There's no limitations there, provided that by the 180th day, you make an investment amount that equals the amount of gain in which you are looking to defer. And then lastly, when we look at the investment type, with the 1031 exchange, there is that like kind replacement property requirement. So any sort of real estate held for business or investment purposes is going to qualify and constitute like kind real estate. Whereas on the opportunity zone side, technically you would be investing in a qualified opportunity fund that then has the requirement of acquiring and owning qualified opportunity zone property. We deal with the real estate side of the equation, but also, as I mentioned earlier, could be an operating entity as well. Anything that's going to ultimately create jobs for those that live in or near the opportunity zone. So that's the quick overview of what opportunity zones are, what the structure is, what the tax incentives are, and then comparing and contrasting 1031 exchanges to OZs. Something that we don't really expect to see extended beyond the original program length, which was going through 2026. Folks will continue to invest in them all the way up until the end of 2026. And to date, we've seen, the latest statistic I saw was about $80 billion that have flowed into opportunity zones. So there has been momentum behind it. It was a little slow to get some air under its wings and get off the ground. But we expect to continue to see capital flowing in, and we'll see if a program like this comes out again. But for those that are comfortable with the development side, have the gain that's appropriate, often not coming out of real estate, but instead of business sale or highly appreciated stock, it can be a very effective tool for deferring that tax liability.
Well done, Austin. A lot of moving parts here, and I really appreciate you kind of diving in as much as you can in a short amount of time here. Now, I'm assuming if someone has their gains and funds that they want to invest in an opportunity zone, can they come to Real Estate Transition Solutions and you'll assist them in locating or understanding how to best use those funds?
That's a good question. They certainly can. I'm happy to talk with any folks that are contemplating opportunity zones as an investment and whether it'd be appropriate for them. Typically speaking, there's two paths, if you will, as it relates to an owner who is saying, maybe I want to invest in OZs. One of which is they want to do their own project, and that absolutely can be a viable approach, in which case we would typically make an introduction to one of the attorneys that we have worked with to structure the actual funds on behalf of the client. And that would be a handoff to them. And they're happy to put together their package as to making sure that it's compliant as a QOZ. The other would be if they're looking at investing in opportunity zones, but not doing their own project. We work with a number of firms who have put together large syndicated securitized opportunity zone funds. So these are generally going to be anywhere from, say, $100 million single project funds through $500 million multi-project funds, all going to be, for the most part, ground up construction and a few different property types represented within that. But working with large securitized funds so that an individual can have the benefits of the opportunity zone, but have diversification through it. Is something in which we focus directly on as well. So I'd be long answer to a question that deserved a short response, but I would be happy to talk with them. And one of those two paths will probably be a fit for most everyone who would come through.
You get a brief snapshot of why I called him the expert at the beginning of this recording. The guy's unbelievable in the information he can just pull off the top of his head and the contacts that he has, both local to the Seattle area and again nationally. And so I thank you so much for taking the time and sharing a little bit about the comparisons of 1031 exchanges and opportunity zones. Thank you so much, Austin.
Chris, it's been a pleasure.